This is Brad Berry, Chief Investment Officer and Portfolio Manager with Dynamic Wealth Group. Welcome to this market and economic update. In this video, we'll discuss the recent market pullback and what's driving investors' concerns. Specifically, the market fell around 2.5% during the first 2 weeks of the second quarter after beginning the year with the historically strong returns. This was primarily due to the changing expectations around inflation, the Fed, as well as escalating geopolitical tensions in the Middle East. Over the next few minutes, we'll discuss all of these topics and explain how investors can keep them in perspective. First, the recent attack by Iran on Israel resulted in a market decline as investors worried about worsening tensions in the Middle East. While the situation is still unfolding, the initial attack of hundreds of drones and missiles launched from Iran appears to be over. Israel and its allies, including the United States, were given ample time to deploy countermeasures. At this point, many hope that both nations will show restraint to prevent an all-out conflict. Without diminishing the severity of regional conflicts, certainly the loss of life, or the destruction that has been caused over the past few years, many investors may wonder how these conflicts impact the global economy and their portfolios. History shows, as shown in this graph, that while there can be short-term market swings when these events occur, markets also tend to stabilize and fully recover within a year or so. However, events such as 9/11 and the war in Ukraine did take longer for a full recovery. It is also worth noting, as we have discussed in the past, that there are many variables, endless really, that can impact the market on a day-to-day basis. And frequent followers also know that I am a key believer in, as we say, preparing for the future and not predicting the future. Thus, while geopolitical events are important for many reasons, it's critical for investors to not overreact with their portfolios. My over 2 decades experience has taught me that making logical, fact-based financial decisions is better than emotional, fear-based decisions. Second, investors have also been concerned in recent weeks due to stubborn inflation data. The latest CPI numbers, for instance, show that headline inflation worsened on a year-over-year basis, while core inflation has barely budged. One reason for this is worse than expected shelter inflation, which is a measure of rents and housing payments. The deceleration in housing costs that many economists hope for has not fully materialized in the data just yet. This has led markets to expect fewer rate cuts this year. At the same time, market-based expectations have swung 180 degrees since the start of the year, when many believed that the Fed would have to rapidly cut rates if a recession were to occur. Instead, the economy has remained strong, leading investors to rethink the forecast. All along, the Fed's forecasts have shown that 3 rate cuts are possible this year. Regardless of the exact timing and number, this still represents a reversal of the rapid rate hikes that occurred from 2022 to mid-2023. Investors should continue to focus on the bigger picture rather than specific timing and size of the cuts. Finally, it's important to keep the recent market pullback in perspective. In general, the market experiences several major pullbacks each year, as shown with the red dots on this chart. And yet history shows that markets tend to recover and end on a positive note, as shown with the blue bars in this chart. This is why investing with a long time horizon is so important in order to benefit from recoveries and bull market expansions. Now, this chart also illustrates why diversification and having investments that are non-correlated to the stock market is so important. You can see many years where there are double-digit drawdowns. This can be extremely painful for investors and lead to those emotional, fear-based decisions that I talked about. Thus, having a truly diversified portfolio built to your time frame and risk tolerance is key. Now, we've only scratched the surface on these important topics, but we hope you found these insights valuable. If you are a financial advisor and would like more information on our multidimensional approach towards asset management, please visit our website at dynamicwg.com, or reach out directly by emailing us at info@dynamicwg.com. If you are an individual investor, we are happy to address any question you may have and put you in touch with a qualified advisor if so desired. Until next time, take care everyone and make smart, logical, and fact-based decisions.